5 simultaneous shocks are hitting the global economy right now. A Middle East energy crisis, a historic tariff regime, an inflation alarm not seen in 4 years, a central bank trapped between two bad options, and a $1 trillion tech correction. Today, we break down each one and the hidden opportunities inside every crisis. Let's start with the biggest geopolitical shock of the year. On February 28, coordinated US and Israeli strikes hit Iran, killing Supreme Leader Ali Khamenei. Iran retaliated with missiles and drones across 9 countries. But the real economic weapon came next. Iran's Revolutionary Guard issued warnings prohibiting all vessel passage through the Strait of Hormuz. This narrow waterway between Iran and Oman is just 21 miles wide at its narrowest point, and it carries 20 million barrels of oil every single day, roughly 20% of the entire world's seaborne oil supply. Within days, tanker traffic dropped 70%. Over 150 ships anchored outside the strait, refusing to enter. The strait isn't formally closed, but for commercial purposes, it might as well be. Now here's where it hits your wallet. Brent crude surged 13% to $82 a barrel. The cost of hiring a supertanker from the Middle East to China skyrocketed 94% to a record $423,000 per day. And analysts are warning this could be just the beginning. If the strait remains effectively closed for weeks, oil could spike above $100 a barrel. But this isn't just about gas prices. The Strait of Hormuz also handles massive volumes of liquefied natural gas from Qatar, the world's largest LNG exporter. European gas prices are already climbing. Every manufactured product that relies on petroleum-based inputs, plastics, chemicals, fertilizers, faces rising costs. The ripple effects will take months to fully materialize, but they've already begun. Now layer on crisis number 2. In late February, the Supreme Court delivered a landmark ruling, striking down the administration's use of emergency powers to impose broad tariffs. The case, Learning Resources versus Trump, challenged tariffs under the International Emergency Economic Powers Act. The court said no. But the White House didn't back down. Within days, they pivoted to Section 122 of the Trade Act, a rarely used provision that allows a temporary import surcharge to address international payment imbalances. The result, a 10% tariff on virtually all imports, covering roughly $1.2 trillion in annual trade. This isn't targeted, it's a blanket tax on everything entering the country. From raw materials to consumer electronics, from auto parts to food ingredients. And unlike the previous IEEPA tariffs, this one has a clearer legal foundation, making it harder to challenge in court. And here's the alarm bell. The ISM Manufacturing Prices Index just hit 70.5 in February, the highest reading since June 2022. This is a leading indicator that most people don't track, but Wall Street watches it obsessively. Here's why. Historically, when this index crosses 70, consumer prices follow 3 to 6 months later. The tariffs are already embedded in the supply chain. Manufacturers are paying more for steel, aluminum, and petroleum-based products. And they will pass those costs to you. This isn't theoretical, it's happening right now. Combined with the oil shock from the Hormuz crisis, we're looking at a potential double supply-side inflation hit. One driven by tariffs, the other by energy costs. And that puts the Federal Reserve in an extraordinarily difficult position. The Federal Reserve is now staring at its hardest decision in years. At its January meeting, the FOMC held the federal funds rate steady at 3.5 to 3.75%. Their projections still show 3 rate cuts planned for 2026. The logic was straightforward: inflation was slowly falling toward the 2% target, and the job market was softening enough to justify easing. But that was before the Hormuz crisis. Before the ISM prices data. Before the full weight of Section 122 tariffs hit the supply chain. Now the Fed faces a classic dilemma. Cut rates to support a weakening labor market and risk fueling a new inflation wave. Or hold rates steady and watch the economy slow under the combined weight of higher energy costs, tariff-driven price increases, and geopolitical uncertainty. Here's what I think the Fed will actually do. They'll likely delay the first rate cut from their original timeline. March is almost certainly off the table. The next FOMC meeting in May will be the real test. If the Hormuz situation de-escalates and oil prices stabilize, they could still deliver 2 cuts this year instead of 3. But if oil stays above $80 and the ISM Prices Index remains elevated, even 2 cuts become difficult to justify. The wild card is the labor market. Unemployment sits at 4%, not terrible, but trending in the wrong direction. If the jobs data deteriorates sharply, the Fed may be forced to cut even in an inflationary environment. That would be the nightmare scenario: stagflation, rising prices combined with rising unemployment. It's not the base case, but for the first time in years, it's not impossible either. Crisis number 4 has been building for months. The great AI stock correction of 2026 is here. After 2 years of euphoric gains, and anything but AI sentiment has swept through markets, investors are questioning whether the hundreds of billions poured into AI infrastructure will ever generate proportional returns. The result: some of the biggest names in tech are trading at significant discounts to their 2025 peaks. Nvidia, the undisputed king of AI chips, has pulled back sharply. Broadcom, riding its custom AI chip business, faces similar pressure. Even Microsoft, which integrated AI across its entire product suite, hasn't been immune. The trigger wasn't any single event, it was a collective realization that the gap between AI investment and AI revenue is wider than Wall Street initially priced in. Companies are spending aggressively on computing power, but the monetization timeline keeps stretching further out. But here's the contrarian case. The fundamentals haven't changed. Wall Street still expects Broadcom's revenue to grow 53% this fiscal year. Nvidia's data center business continues to set records. The AI infrastructure build-out is not slowing down. Cloud providers have actually increased their capital expenditure plans for 2026. What's changed is sentiment, not substance. And history tells us that sentiment-driven corrections in structurally growing industries create some of the best buying opportunities. The key metric to watch is the gap between AI capital expenditure and AI-driven revenue across the major cloud providers. When that gap starts narrowing, and quarterly earnings reports later this year will tell us, the narrative will flip from AI is overhyped to AI is delivering. For patient investors with a 12 to 18-month horizon, this correction may look like a gift in hindsight. Now for the surprise in this story. While the US grapples with tariff-driven inflation and the Middle East burns, Europe is quietly staging a manufacturing comeback. The Eurozone manufacturing PMI just hit 50.8, a 44-month high. For the first time since June 2022, the index is above 50, meaning the sector is expanding rather than contracting. Germany, long the sick man of European industry, crossed back above 50 at 50.9. This matters for the global picture because it shows that economic momentum isn't uniformly negative. Goldman Sachs forecasts global GDP growth of 2.9% for 2026, above the consensus estimate of 2.7. The world economy is resilient, but the risks are stacking up. And this is the key insight: these 5 crises are not independent events. They're interconnected. Let me connect the dots. The Hormuz crisis drives up oil prices. Higher oil prices feed into the ISM Prices Index, compounding the tariff-driven inflation. Rising inflation pressures the Fed to delay rate cuts. Delayed rate cuts keep borrowing costs high, which pressures growth-dependent tech stocks, including AI names that already face skepticism about their revenue timelines. Meanwhile, higher energy costs could stall Europe's manufacturing recovery just as it's getting started. And the tariffs? They don't just raise prices domestically. They invite retaliatory measures from trading partners, creating a feedback loop of escalating trade barriers. This is what makes March 2026 so unique. It's not one crisis, it's 5 interlocking crises where solving one often makes another worse. Cut rates to help growth? You risk inflation. Maintain tariffs to pressure trading partners? You raise domestic prices. The margin for policy error is razor thin. So here are the 3 things every investor should watch this week. First, oil prices. If Brent crude pushes above $90, the inflation calculus changes completely and rate cut expectations will need to be repriced. Second, Friday's U.S. jobs report. If unemployment ticks above 4.1%, the Fed's hand may be forced regardless of inflation. Third, watch the AI earnings calendar. When major cloud providers report their next quarters, the data will either validate or destroy the AI investment thesis. Each of these data points is a potential inflection point. The global economy is walking a tightrope right now, and any one of them could tip the balance. Stay informed, stay diversified, and above all, don't let any single narrative drive your decisions. The world is more complex than any headline suggests.